In this chapter, we look at something that probably some of you probably thought we were going to look at almost in the beginning of this course, and that's this idea of of looking at basically what is money and understanding much better what the central bank does, the Federal Reserve. And so that's what we're going to do in this chapter. And to contextualize it, the reason why we're talking about money is so that we can understand, we can better understand what monetary policy is. Okay. Let's go over the. So the simple question that we want to look at here is how does changing the money supply, which we know of as monetary policy, how does changing the money supply, which is what the central bank does, the Federal Reserve, how does that change the economy, the performance of the economy? And it turns out that what the government does is so much less important than what the central bank does, and hopefully we'll see that in this chapter as well. So, what is money? This isn't just a philosophical question. We're actually thinking about it right now in terms of like, what does Bitcoin represent or cryptocurrencies? Are those money? Now, you may already be trying to answer that yourself right now as I'm talking here, but as we look at these definitions, one of the things that we'll kind of see here is that it's a little bit harder to um, see it as money, but we'll get into what that means. So, what is money? It basically has to be three things. It has to be all three things. It has to be a means of payment, meaning it's a way to pay bills, to receive payments for working. It's a store of value, meaning it stores its value over time. And it's a unit of account, meaning that it's the thing that payments and bills are all represented in. So in the case of the US dollar, right, um, I receive from the university my payment in dollars. Those dollars can be used to pay bills that are from services delivered a month ago. So it's storing value over that period of time. And it's the unit of account. It's what the people want to get paid in. As we see here, even on just this kind of simple definition, already the problem is going to be for cryptocurrency, it doesn't meet some of those conditions. So, what would we do if we didn't have money? Well, if we didn't have money, then we would have to directly exchange goods using a barter system, right? And so that would mean that in my case, I would have to deliver economics lectures for food and for rent, right, or my mortgage payment and other kinds of things. Um, it's obviously not easy to do that because I'd have to find people that want economics lectures. And to be honest, what am I going to get from you, right? What are you going to do for me for my economics lectures, right? Unless you're growing food or fixing my car or giving me a place to live, right? There's not much more I need from you. So, right, it's just to make life, a little bit easier. We've got money, something that you can pay me in, and something that I'll gladly accept. So there we go. It's the means of payment. It's what you are willing to offer me and what I am willing to accept. It's mutually agreed upon the use of this dollar. That's what gives it the value. By contrast, and I only offer this as contrast for better understanding of this. One of the things that many of the cryptocurrencies do not fulfill is this condition of a means of payment or a medium of exchange. Because if I want to find people out there that are willing to accept cryptocurrencies, there's not too many. I think like Domino's is like one of the classic examples of a place that accepts it. Um, I think. I'm not even sure. Mm, I'm not even sure. Okay, so just according to this Australian website, no, but see here, Domino's is not directly accepting Bitcoin. To just have a service that allows you to pay in Bitcoin. Um, there's our problem, right? Who's going to take my Bitcoins that I have? It starts to not be money. It's something else. Here's our store value purpose. How is it holding its purchasing power over time? Um, is it easy to use it? And again, to contrast this for cryptocurrencies, we see that the value is changing rapidly over time. Plus, it's not easy to turn it into dollars, or it's costly to turn it into dollars. And then again, the money needs to be fulfill the condition of serving as a unit of account, something that the prices are quoted in. And to be honest, the dollar is the dominant way that we quote prices in the United States. In Canada, they use both the Canadian dollar and the US dollar, as far as I'm aware. And in the European Union, you would see either the British pound being used in England, in the European Union itself, the euro, with the exceptions of like Switzerland and the Nordic countries using their own currencies. Let's not focus on birds. Well, I guess there's this. Whenever someone does a chapter on money, they always talk about the things that have served as money. In this case, that in these islands, I guess they used some feathers from a bird. I'm not really sure. Um, the other one that's of used quite a bit is the rye stones um, that were used on the island of Yap, which was a big stone circle. Here in Hawaii, obviously where I'm, we did have a piece of stone money. I think it was owned by First Hawaiian Bank, and then I think we got rid of it. I think, or no, actually, I think it was the Bank of Hawaii that had it, or maybe it was First Hawaiian that had it. We only have, oh yeah, it used to have a branch in on yeah. Oh, interesting. That's very interesting. I'm just seeing this for the first time here. So, Bank of Hawaii, which would be my local bank here, actually had a branch on Yap, and individuals would deposit um, the currency, the Ray currency, and that would be used to generate dollars. Um, Very interesting, huh? Very, very interesting. Okay. Now, there's two kinds of money that exist in the world: commodity monies and fiat monies. And it turns out that commodity monies are incredibly rare. We really don't see a great deal of them. Commodity monies, the classic examples of these are the gold standard and the silver standard, where um, the coins, the silver coin or the gold coin, contains the actual element of gold or silver. So it has some intrinsic value. I guess you could even say that stone, right, had a intrinsic value, right? You could use it as a paperweight or something else, I guess. Um, it's just you don't see those very often, if at all, in the modern economies. And the reason why, well, the last time they were used in the U.S. for pop for consumers to own them for tradable coinage would be 1933. President Franklin Roosevelt, with the Great Depression, um, changed the currency from a commodity money to a fiat money. Now, what a fiat money does is if you look on your dollar bills, it's got a note on it that says, "This note is legal tender for all debts, public and private." I'm just quoting that from memory. It's probably something along those lines. This note is legal tender for all debts, public and private. Basically, it's saying that it's U.S. law that the dollar has to be accepted for debts, right? And this is the thing where then like people like, I'm sure I can easily look up this one, um, where people paying parking tickets pennies, right? Because it's also legal tender. Um, um, you can, I guess, as it says here on Core, which I guess we should allow it, you can pay your parking fines in pennies if you wish. And dude, don't be that person. It's just, just accept the fact that oh, look at that. Jeez. Like, don't be that person. It's just annoying. Um, let's just be kind to each other, right? Like, don't be this guy with the cowboy hat who just looks like the kind of guy who would pay a parking ticket with pennies. Or that guy. I'm sorry if you look like that guy, and I'm just saying by looks you look like the kind of person that would pay it with pennies. But I mean, come on, you're looking at it and you're thinking the same thing. Okay, I'm gonna get back to something that's less controversial here. Um, the monies that we have here is the U.S. dollar. It is a fiat money because the government says so, and crypto will never be considered money until the government um, honors it as money. And so, what's interesting about that is that the Federal Reserve is doing this long, drawn out process of trying to create its own digital currency, which is kind of like um, they'll take forever and um, nothing will probably ever happen. But we actually do have a pretty good example in China. During the Olympics, they created something known as ECNY for E Chinese Yuan. It's a digitized version of the cash, and so it's a way to basically now it's not using blockchain as far as I'm aware. So that would be a pretty big difference with. It's not so it's obviously saying here it's not a cryptocurrency, but you could see this as a step, right? Because once you've got the infrastructure set up for electronic payments, it doesn't take much more to expand it to using cryptocurrencies. So this is kind of like a baby step towards that. Now, what has you can't force people to use a fiat money. So even though in the United States the U.S. dollar is the legal note accepted for all debts, public and private, the reason why you and I, all use it is because a promise has basically been made to us, an implicit promise, not explicit. But that implicit promise is that it's going to store its value well. meaning that the government's not going to print more cash, more money. Because if the government prints more money, the effect that that has is it reduces the value of the dollars that exist, right? Because there's more of it, there's more supply. And what exists out there is then less valuable. And so um, we see in countries where this promise is violated, like in Zimbabwe, for instance, being the classic example, we see those economies using other kinds of currencies as well, most notably the US dollar or anything else. Now, in terms of defining money and how it exists, um, the um, the first level of money called M1 is the level where things are most liquid. And by that we mean it's basically cash. It's immediately usable for transactions. And you can see with the components that it includes, sorry, it's including things that are pretty much cash, which is currency, checking accounts, traveler's checks. You don't really see those too often, and other kinds of checkable deposits, things that you can write checks on. Those things are basically accepted as cash, not debit cards. Debit cards are um, debit cards themselves are just a way of accessing your demand deposits, which is a checkable deposit. Again, old data. We don't need that. Let's look it up. And look at that. You can see other people are using it for this purpose. Let's look at what the size of M1 is. 20 trillion. And just look at that right there. Just look at that. I'm going to pause here for 10 seconds. You look at that. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. And now my question for you is the currency debased? Has the promise that the government will not dramatically increase the money supply and thus devalue it been violated? And I would argue it has. At least the data suggests it has. In fact, let's just edit this a little bit. Let's do compounded annual change. And let's look at it on an annual basis. Look at that. For the longest time, the money supply has not changed by very much on an annualized basis. It increased dramatically during the 2008 2009 crisis for what at the time was historic levels. But now, at its peak, you increase the money supply by over a factor of 2. So I'm not surprised that we're seeing inflation right now, meaning that the purchasing power of our money has decreased dramatically because, dude, used to be 36.64. And now it's almost 20. I don't know how you dude, that's a really big increase. And I laugh just because it's that shocking. So think of this in a pyramid sense, meaning M1, that's our transaction money. M2 is now covering everything in M1 plus some things that are a little bit less liquid. such as savings accounts, money market accounts, and other near monies. So, a savings account, technically speaking, you're not allowed to take that out for a certain number of days. That's what the banking law is. Something like a money market account, technically speaking, you would need to, we don't experience it because of the amounts that all of us have as money, but um, technically speaking, it's not holding money, it's actually holding investments that in some sense need to be settled when the markets are open. So it's a little bit less liquid. We would obviously expect that M2 will be large. Let's look at how much it is. Again, value of this course would be you can look at this data all on your own. And we see that increase as well. And that increase is pretty substantial still. Now, this increase doesn't look to be as much because one of the concerns during COVID was that people weren't going to have access to cash, banks closing down, things like that. So there's a real concern about liquidity. So there was a lot of cash printed. But you also just see the money supply increasing here. In fact, if we look at this again and do compounded annual change and look at this on an annual basis, you still see more money supply being created here. And this is as of January 1st of 2021. And then you can even go further than this and start to look at M3, M4. We're not going to generally talk about these kinds of things. Although the second bullet point here, I do not agree with the second bullet point. There are rules for deciding what is and what is not money. The rules are those three: unit of count, store value, medium of exchange. That is the money. Credit cards are not money. Credit cards are a means of paying for things. But how do you pay your credit card bill? You pay for it with either cash or a checking account, right? Or a direct debit from your checking account or a direct debit from your savings account. So credit cards are not money. They're just allowing you to access your money and add some extra features like not having to pay interest on it for 28 days, the billing cycle. So I disagree with it saying that credit cards are money. Debit cards are also not money. Debit cards are a means of accessing your demand balances. Um, I mean, what I don't want to talk too much about these three slides. I mean, it gives us kind of a sense of like why the world why the world is the way it is. So it turns out that long ago, right here we're talking about the 1400s and 1500s, is that people used gold. People trusted gold. But I mean, I don't own a lot of gold. I actually don't think I own any gold. I shouldn't say I don't own whatever's in my computer. That's what I own as gold. I don't own any gold. I don't own any silver outside of I don't know, maybe little bits exist in old coins. I just don't know those things. But from what I'm told, all that I'm told, and I've once held a gold brick, they're really freaking heavy. Um, and you can't imagine people wanting to hold those kinds of things and carry those kinds of things around. So as a result, they would give it to the goldsmith to kind of hold and um, store for them, and they would pay something to the um, goldsmith to store it. And the goldsmith would give them a piece of paper, and that piece of paper would say, "Hey, you've got some gold sitting here, and when you bring me back this piece of paper, I'll give you your gold back." Now, the thing is, as the third bullet point highlights, people go to the didn't get their gold out all the time. People would get a pretty predictable amount, and what that means is that the goldsmith held all this gold, and they had all this paper out there um, for people holding this. But the goldsmith, what they were able to do is that they could also lend money, right? Because they have all this gold sitting there, and they know not everyone's going to come to get the gold at the same time. They could say, "Hey, why not use this guy's gold?" Right? And as long as it wasn't within crazy amounts, right, and the goldsmith was trustworthy, then the system would work. The problems would emerge if all of a sudden we found out that Tom the goldsmith, all of a sudden is spending a whole bunch of money, meaning spending my depositors' money, and all the depositors come to my bank at once and ask for their gold back, then the goldsmith's not going to have it because he lent out some of the money. Um, and so we would call that is a run on the bank. Now, the last time we had a run on the bank was during the 2008-2009 crisis. Washington Mutual had some. Mm, it's going to have one here. There's going to be one for Washington Mutual, or Wachovia had one. I thought, yeah, Washington Mutual had one too. So it's a really interesting book. If any of you are book reader kind of people and you like this kind of thing, there's a really interesting book. Let me look at it. It's in my Audible account. Because I read it and then I actually listened to it as well, just to kind of watch this or read it a second time. The book is called. Sorry, I have to look. Um, it's called The Lost Bank, by Kirsten Grind. Um, and it actually talks about the starting of Washington Mutual as a bank up to its decline. Basically, what happened for Washington Mutual is that there was a lot of money going out. The deposits started going out. They had made a lot of housing loans. The housing market collapsed. All these deposits, all these loans were bad, and people started wondering, is my deposit going to be there? And so they all started going to the bank. Now, the way that most bank runs in the United States, the reason why they're pretty rare is that we have something called the FDIC, or if you belong to a credit union, called the NCUA. And what the FDIC does, Federal Deposit Insurance Corporation, it emerged during the Great Depression, and it basically makes depositors whole up to a certain amount. In this case, $250,000. So you can have up to $250,000 in the bank as a deposit, and it will always be there. The government will make sure of it. So I actually had an account at Washington Mutual. I had a lot of branches, even in on the West Coast. But in my case, I lived in Pennsylvania, but they had an online bank, and I had an account there. And yeah, I didn't take my money out. I knew that the bank was failing. I still knew people that worked at the Federal Reserve and whatnot that were telling me that the bank was failing and that they were concerned. And I didn't think much about it because I knew I had under that amount. In that case, at that time, it was $100,000. Um, I didn't really worry about it. When I was with the Federal Reserve, um, we would typically go to a bank to close it on a Friday. when banks usually weren't open on Saturdays and Sundays, and we would close the bank on a Friday. Usually, we would have kind of an arranged marriage kind of site. Usually, we don't want banks to fail. We usually can find another bank that's willing to buy up all the branches and the deposits, and basically take over the business. But sometimes we can't find a bank to take over others. You can actually look up the data yourself on FDIC.gov. And you can, again, just to kind of, what is the point of this course, and how are you, so right here, the Deposit Insurance Fund has $121 billion in money that it can pay out. But what I'm looking for here is the data on the last one that failed. Sorry, it's just not easy to find here. Well, what do I need to do? Failures. There we go. So I can search this in any number of ways. Let's search it by state. We've got Pinnacle Bank of Oregon that was actually bought by Washington Trust Bank of Spokane, and that failed during the 2008-2009 crisis. In my state of Hawaii, well, I know we've had banks fail. Question is, this is the big one. In 2000, Bank of Honolulu was bought by the really badly named Bank of the Orient. It's a pretty old term. But you can kind of look up those kinds of things, and you can see run-of-the-mill banks. And the classic example that we see here, and so I'm just going to skip over this and then go back to it, is the classic example would be if you watch the movie It's a Wonderful Life. There's the scene where everyone is running to the bank to take their deposits out. That is what a bank run looks like. A bank run looks like people standing outside the bank branch all trying to withdraw their money at the same time. The reason then, so going back to slide here, is that is kind of the way that banking exists right now. Banks in the United States, including credit unions, are required to hold about 10% of their deposits. That's required reserve ratio. So if we all had a common bank and I spread a bad rumor that bank was about to fail, you could make a bank collapse if you can convince enough people to do to believe what you're saying. Rumors can destroy the banking system, and people might not care about the FDIC. And also, keep in mind, there are rich people out there who actually might have more money, and it would actually hurt them where they would actually lose money. Because if you have more than the insured amount, you do not get the extra amount. Okay. So let's look at the kind of briefly the way that this is accounting would work here. So from a balance sheet perspective, when we look at the bank, it would be assets on the left-hand side of the balance sheet, and then liabilities plus shareholder equity or net worth on the right-hand side of the balance sheet. And those two need to equal. Assets need to equal liabilities plus the net worth, the shareholder equity. As we start to think about this, the thing that we need to go back to is the central bank that exists, and that would be the Federal Reserve. So in the case of the Federal Reserve, or the Fed. The Fed is the central bank in the United States. Um, and for the central bank, um, or for any bank, we have assets on one side, and then we have liabilities and shareholder equity on the right hand side of the balance sheet. The assets, a big asset would be the loans. Another asset would be the required reserves it's holding in its bank vault. The liability are the deposits, right? Because it's going to owe those people that money. So liabilities is anything that it owes, as it says right here. Assets are basically what it owns, and we want what is owned to equal what is owed. So, the reserves, again, that would be the amount that the bank needs to hold, and it's going to hold that amount, those required reserves, at the Federal Reserve Bank itself. It's legally required to hold a certain amount. That amount that it's required to hold is the required reserve ratio, which, again, in the United States, it differs by size of bank, but for the most part, it's about 10%. Which would mean, if we just disregard the shareholder equity, which is like, buildings, machines, things that a shareholder would own within the bank, that the reserves and the loans, which are the assets, need to equal the liabilities, which would be the deposits plus the shareholder equity, which is the net worth. The two must always equal. Accountants say it must be so. Now, the fact of the matter is that banks lend out the extra amount, like a goldsmith would. Right? So the total amount of the deposit consists of two types of reserves: required reserves and excess reserves. Those excess reserves are what it holds in excess. And it can lend that out. Can, but it might not always. So here's another cool graph here. Now, this one's not, they stopped updating this, unfortunately. Last about a year ago, but you'll get the idea of the trend. Again, I'm going to pause here. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. I'm not much for how has banking changed, but banking has changed since this textbook was first written in edition 1. And to be honest, since I received my PhD in 2006, banks hold excess reserves, dramatically large excess reserves, and that has been the case ever since the 2008-2009 crisis. Banks almost never held any excess reserves. And when I was with the Federal Reserve, banks just, they didn't do it. They lent out money. That was the purpose of what they did. And the 2008-2009 crisis just changed it all. And now banks feel safer. The largest banks feel safer when they hold excess reserves. And obviously during the pandemic, with all the uncertainty that accompanied that, it obviously reset the progress that was being made here of banks lending out more and more money. The banks are lending it out. They do not want to hold excess reserves. So if banks are holding excess reserves, what we see is this process in the fractional reserve banking system where initial money grows into more amounts. So let's kind of talk through this here. So there's an initial deposit of $100. And so in that initial deposit of $100, it's deposited. Um, and what we can see here is that it must have about a 20% required reserve ratio. How do I know that? Because 100 is 20% of 500. So it has its, in panel one, there was no money there. Then the money was deposited, and we still had assets equaling liabilities. $100 deposit, $100 in my bank vault. Then it took what was in the bank vault, right, the $100, and it lent out 20% of that, or sorry, held 20% of that in required reserves and lent out $80. Okay. And that process is going to keep continuing on. So now there's another bank which is going to have a deposit of $80 and it's going to hold $18 in required reserves and lend out 64. And then there's going to be another bank which is going to have a deposit of $64 and then is going to lend out, or sorry, is going to have to hold $12.80, right? And then the remainder is going to be, and this process keeps continuing where each successive bank keeps holding 20% and lending out the other 80%. And as that process keeps going on and on and on, as you'll see in the textbook, ultimately, all the required reserves will equal that initial $100, and all of the loans that keep being made up, $64 of $80 and $64 and so on and so forth, are all going to add up to $400. Adding up those two, that means that all the banks together are going to have deposits of $500. And that's what you see right here, right? $100 and $80 and $64 and $51.20, then right, and it goes on and on and on and on and on. You add that up, it equals $400. Now, I'll be honest. When I started teaching this course, almost a decade and a half ago, this was pretty important to cover because this was the way that banking occurred. As time has gone on, I'm emphasizing this less and less because this is actually not that realistic. As you can see, banks aren't lending out all that they can. In fact, they're holding a lot of their reserves. So you still need to learn this, unfortunately. But keep in mind, it's not exactly the way that banking occurs nowadays. That amount that we can calculate is called the money multiplier. How we turned $100 into $5. In this case, 1 over 0.2 is equal to 5. So the change in the money supply times the money multiplier equals the change in the money supply. Sorry. In this case, 100 times 5. By the Federal Reserve printing or increasing the money supply by 100, the fractional reserve system put in also 400, basically by its act of lending out, such that the ultimate change was 500. Now, if banks aren't lending out all that they can, the money multiplier is smaller, which would mean that the change in the money supply is becoming less predictable. So let's talk a little bit more about the Federal Reserve System itself, which I'm sure many of you have heard about when people talk about the Fed. Federal Reserve System was created in 1913. I have actually made a separate video in economic history, in a course in economic history that I teach that talks about this much more. So if you're interested in that kind of thing, let me know and I'm happy to share that lecture with you. But that would be beyond what you need to know. Um, and with the Federal Reserve System, um, it was created to serve as both a bank for the federal government, but also to um, supervise banks. And then with Keynes and kind of that macroeconomic revolution that happened with the Great Depression, and many believe that the central bank didn't do what it was supposed to do when the Great Depression first started, which is kind of why we had to have those reforms. Um, the Federal Reserve got more powers with the Great Depression, um, and um, that Federal Reserve, despite its name, it is not part of the government. It is independent of the government, although the government does, the president and the Congress appoint and confirm leaders within the Federal Reserve, um, such as the Board of Governors. Um, it's independent. This, I think, the best example we have of that is Trump wasn't entirely happy with Jerome Powell, but at the end of the day, there wasn't much he could do about it. So the most important group within the Federal Reserve System is the Board of Governors, and the Board of Governors consists of has 7 individuals on it. Those 7 individuals. Let's just actually look at who they are. Right now, the Biden administration actually is empowered to appoint many of the members because many of their appointments had just expired. Some of these names, what's interesting about this is that you're not going to really hear too much about them because they're just not in the news that much. Um, let's just scroll all the way down to who we have right now. So Chris Waller, I actually know him. I'm not trying to push a name there, but I do know him. He's a nice guy. Actually, let's. No, let's. This is just a bad way of organizing it because you would have to search through all the members and find out who resigned versus who's on it. So you'd have to search through it this way. But you got Waller, Bowman, Brainerd, and Powell, and maybe does that give us 1, 2, 3, 4. There's our 5, 6, and 7. You'd have to scroll through. There's got to be a better way of doing this. Let's go to Wikipedia. At least we'll get a good list there. Oh, no, that's why. Duh. Sorry. I don't know why I wasn't actually thinking about that. That is what the Biden administration gets to do right now. They get to appoint the remaining members of the Board of Governors that we have. So their site was right. It's just very awkward looking. Some of these members have left because the President Biden just has a very different philosophy of the role that the Federal Reserve Bank should take in the economy. A good example of that would be some of the struggles that he's facing right now to appoint new members. So I'm sure by searching this way, we'll find out something about the appointments. There we go. Right. Wall Street Journal is unhappy about this person. And you're gonna read all about it. I'm not gonna. You don't need to know what my opinion is. Okay. And then the most powerful group then outside than the Board of Governors would be the FOMC, the Federal Reserve Open Market Committee. The FOMC has all 7 members of the Board of Governors. And then it has district presidents. So let's just jump to that here. So we can see that this map, as originally drawn up in 1913, looked like an economy that was focused primarily on the East Coast. And so poor San Francisco District 12 covers a rather vast area. I worked in District 7, pretty much auto manufacturing and crop growing and train travel. That was kind of our primary reasons. Minneapolis, that would be a lot of grains and harvesting. Kansas City, same thing. New York, that would be kind of the financial markets. And you can kind of see that movement here. So each of those dots represent the district, the regional branch office. And then within each district, there are some separate offices as well. For District 12, there's an office in LA, one in Vegas, I think one in Salt Lake City, one in Phoenix, and I believe one in Seattle. Right, and so you see that, and they kind of do some of the underlying activities as well. And you can see that for each branch. So I got the wrong website. Sorry. So San Francisco is the branch. Oh, Jenya, I know her. And then we can see that the offices again here. Yeah, we've got, we do have, not one in Vegas, but we have LA, Phoenix, Utah, Portland, and Seattle. Phoenix is where they process the cash. Obviously, a lot of cash is generated in Vegas. And then the Federal Reserve also operates what's known as the open market desk. The open market desk would be where the Federal Reserve buys and sells existing government securities, U.S. government debt. And that is what the FOMC does. The FOMC buys and sells existing debt so as to change the money supply. And that's the important way in which the Federal Reserve impacts the economy as a whole, is it changes the money supply, which in turn changes the interest rates in the economy. When the FOMC buys government securities, that is increasing the money supply because it's paying for those securities, that government debt, with money that never existed before. When it sells government debt that it's holding, it reduces the money supply because the government basically, or the Federal Reserve, is accepting money for those bonds that it's selling, and then it basically destroys that money, right? We could think of it as physical money. It destroys that money from existing. Now, there's other things that the Federal Reserve does as well, and they are important. It is a bank for other banks. It like, for instance, when you write a check, it manages the writing of that check. That actually used to be the way that the Federal Reserve made most of its money, was by processing checks. The Federal Reserve, when I was there, made about 76 cents for every check that was processed. People aren't writing as many checks anymore. Actually, I wonder, can we see that here? data on this. Yeah. Hmm. Yeah, we can actually go. Um, you can read this article from the Atlantic. Although today I just wrote 3 checks today, so I don't know how good of an example I am about talking about this. But the Federal Reserve, the big thing is the second bullet point, that it controls the money supply, and it does that primarily through the FOMC. The other thing that the Federal Reserve does that's pretty important is that does create trust in the U.S. dollar because of the fact that it is the lender of last resort. When no one will lend money, it is the thing that will step in and provide that money. And we certainly saw that during COVID 19 when it came out there. So that's the money supply side of this equation. The other side of this would be the demand for money. And just like in a supply and demand graph, here the money demand is negative in terms of interest rate, positive in terms of number of transactions. But what you could do here is that if I put interest rates on the y axis and I put the quantity of money on the x axis, here would be my demand for money. Right? And we see that right there. The money supply would be completely vertical because it's unaltered by the interest rate. It's what the Federal Reserve has printed. It determines the interest rate. But now you can also see, based on the previous slide, as it changes the money supply, it can change the interest rate. Pretty cool, huh? So that's what we mean when we say that the Federal Reserve impacts interest rates. It doesn't directly impact interest rates. Rather, it changes the money supply, which in turn changes the interest rate. Let's look at this right here. Website to just kind of always get a good handle on how interest rates are changing overall. Bankrate.com. Let's say that I want to buy a house. And we can see here that the 30-year fixed rate mortgage is now 4.17%. Disregard all these kind of advertisements. If I want to look at the trend here, I mean, basically, we see here that the interest rate has been going up over the past several months. And it's doing that because the Federal Reserve is basically been telegraphing, been communicating over the past several weeks that it intends to reduce the money supply. Reduce the money supply, you say, Scheiding? Yes. So by reducing the money supply, that would increase the interest rate. And so banks are like, oh man, there's going to be less money out there. We need to change the interest rates. We need to charge higher amounts. Don't worry about this slide. That's not, I don't want it to confuse you. Same here. Let's not worry about security prices. So what you can see here is that when the money supply then changes, and I'm not sure why they're not showing us the vertical line here, but as that amount changes, the interest rate itself changes. 2008 did represent a large change in activities, and it represents the time when the Federal Reserve did get much more involved in the banking system. It started buying mortgages. It started buying other longer government bonds. You can actually see this in Fred. Look at the balance sheet of the Federal Reserve. that doesn't look that easy to see there. I don't want to focus on that here. Let's just look at the balance sheet here. Okay, let's look at this from 2021, November of 2021. So see this? See what happens. Well, let's see if they have actually longer dated data. They don't. That's pretty deceptive. Well, you can kind of see here this description of all the other things now with COVID-19 that the Federal Reserve started paying for. Paycheck protection program, commercial paper funding, meaning companies borrowing money, money market mutual fund liquidity, meaning the money market accounts that we hold. All that makes the balance sheet grow dramatically. And you see that right here. And it first started in 2008. In fact, if we look at the web in general, look at the Wikipedia entry for it, well, let's look at it. I mean, you can kind of see here that the amount is growing, but also, let's look at it by images. It's becoming more colorful, and I'm not, checking this site here, but you can see that these addition of additional colors means that the Federal Reserve is buying things other than U.S. government debt. It's buying other things as well. And that's what we see described here in this slide. And that's what we see here. All other assets and mortgage-backed securities being things that the Federal Reserve used to not own, and now they do. Basically, if we look at ways to change the money supply, then the changes would be you can change the reserve requirement. You can change your open market operations. And you can change what's called the discount rate, which is the interest rate that banks pay when they borrow money from the Federal Reserve directly. If I want to reduce the money supply, then I would raise the reserve requirement. I would sell government bonds, or I would raise the discount rate. These would be all things that the Federal Reserve could do individually or all together that would reduce the money supply. It could alternatively increase the money supply. That would mean that it could reduce reserve requirements. Buy government bonds. That was a primary thing it did during the 2008-2009 crisis, as well as during COVID-19. And it could lower the discount rate. The Federal Reserve doesn't really like to use the first and the third tool that much because banks don't like it when you alter that thing too often. So really it's the open market operations. That's the primary thing relied on to change the money supply. And in 2008, what changed there is that those three tools, were insufficient, and it had to start doing new things like quantitative easing to try to help the economy move beyond that. And it used those same tools during COVID-19 as well. Okay, we're not covering the appendix, so you do not need to worry about it.